I need to understand what's happening in the precious metals market right now. The volatility we're seeing isn't normal. Gold has more than doubled over the past year, and silver experienced one of the most dramatic single-day crashes in modern history. But here's what nobody's talking about. This isn't just market turbulence. This is the beginning of a fundamental restructuring of the global monetary system. And if you don't own physical metal right now, you're about to watch your purchasing power evaporate in real time. Let me show you exactly what's happening behind the scenes, because the mainstream financial media is either completely missing the story or deliberately avoiding it. Central banks around the world are accumulating gold at a pace we haven't seen since the 1970s. Not paper gold, not gold ETFs, physical metal, bars sitting in vaults. And they're doing it quietly, methodically, and with an urgency that should terrify anyone paying attention. The People's Bank of China has been adding to their gold reserves month after month. The Reserve Bank of India is buying. Poland's central bank is buying. Singapore's monetary authority is buying. Even smaller nations that never historically held significant gold reserves are suddenly acquiring physical metal. Why? Because they see what's coming. They understand that the current monetary system is built on a foundation of debt that can never be repaid, and they're positioning themselves for what happens next. But here's where it gets really interesting. While central banks are accumulating physical gold, something strange is happening in the silver market. Silver doubled in value over the course of a year, then crashed by 30% in a single trading session. Think about that for a moment. A 30% drop in one day. That's not normal market behavior. That's not investors suddenly deciding silver isn't valuable anymore. That's a market structure problem, and it reveals something critical about how these metals are actually traded. The vast majority of gold and silver trading happens on paper, futures contracts, ETFs, derivatives. For every ounce of physical silver that actually exists, there are dozens of paper claims on that same ounce. It's like a game of musical chairs where there are 100 people and only 3 chairs. Everything works fine until the music stops and everyone tries to sit down at the same time. That's when you get a 30% crash in a single day. That's when the paper market breaks down and reveals the massive disconnect between paper prices and physical reality. Now, before we go deeper into this, I want to mention something quickly. If you're watching this and you're concerned about protecting your wealth, I put together a free guide that shows the saving secrets thousands of American retirees are using to protect their hard-earned wealth. It's in the description below. No cost, no obligation, just information that could be valuable for your situation. All right, let's get back to what's really happening in these markets. The COMEX, which is the primary exchange where silver futures are traded, operates on a fractional reserve system. They don't have enough physical metal to deliver against all the contracts they've issued. They're counting on the fact that most traders will settle in cash rather than demanding physical delivery. But what happens when that assumption breaks down? What happens when a significant number of contract holders say, "No, I don't want cash. I want the actual metal"? We're starting to see the early stages of that breakdown. Industrial users of silver, the companies that need physical metal for manufacturing solar panels, electronics, medical devices, they're getting nervous. They're seeing the price volatility, and they're thinking, we can't afford to have our supply chain disrupted because the paper market imploded. So they're starting to take delivery. They're starting to hold physical inventory, and every ounce they take off the market is one less ounce available for the next buyer. The same dynamic is playing out in gold, just more slowly and with different players. Central banks don't trade gold futures. They buy physical bars and they vault them. When China buys gold, those bars aren't going back on the market. When India buys gold, it's being added to reserves that will sit there for decades. This is a one-way flow and it's accelerating. Let me tell you a story that illustrates exactly what's happening. Back in the 1960s, the United States was running a similar game. The dollar was supposedly backed by gold at a fixed rate of $35 per ounce. Foreign central banks could exchange their dollars for physical gold from the U.S. Treasury. But the U.S. was printing more dollars than it had gold to back them. France, under President Charles de Gaulle, figured this out. They started sending ships to New York to pick up physical gold in exchange for their dollar holdings. Other countries started doing the same thing. And in 1971, President Nixon had to close the gold window because the U.S. was running out of physical metal. That was the end of the Bretton Woods system. That was the moment the dollar became a pure fiat currency backed by nothing but faith in the U.S. government. We're watching a similar dynamic play out right now, except this time it's not just one country calling the bluff. It's dozens of countries, all simultaneously realizing that the dollar-dominated system is unsustainable. The BRICS nations, Brazil, Russia, India, China, South Africa, they're actively working on alternatives to dollar-based trade. They're settling transactions in their own currencies. They're building payment systems that bypass the Western banking infrastructure. And they're backing these efforts with physical gold. Russia's central bank holds a significant portion of its reserves in gold. China's official gold holdings are likely far higher than what they report publicly. These nations learned a lesson when the U.S. froze Russia's dollar reserves after the Ukraine conflict began. They learned that holding dollars means holding an asset that can be weaponized against you. Gold can't be frozen. Gold can't be sanctioned. Gold sitting in your own vault is yours, period. This is why the urgency around physical metal ownership isn't just about investment returns. It's about having an asset that exists outside the banking system, outside the reach of government confiscation or currency controls. When you own physical gold or silver, you own something that has been recognized as valuable for thousands of years, across every civilization, regardless of what any government says. Now, let's talk about what this means for the average person, for retirees, for anyone who's spent decades building up savings in traditional retirement accounts. Your 401k, your IRA, those accounts are denominated in dollars. If the dollar loses purchasing power, which it inevitably will as the government continues printing money to service its debt, your retirement savings lose purchasing power right along with it. You might have $1 million in your account, but if that $1 million only buys what 500,000 buys today, you're not actually wealthy. You're broke. You just don't know it yet. This is where physical metal becomes critical. Gold and silver aren't investments in the traditional sense. They don't pay dividends. They don't generate cash flow. What they do is preserve purchasing power across time. An ounce of gold today will buy roughly the same amount of goods and services that an ounce of gold bought 50 years ago. The same cannot be said for the dollar. The dollar has lost over 95% of its purchasing power since the Federal Reserve was created in 1913. That's not a conspiracy theory. That's just math. So when we talk about owning physical metal, we're really talking about insurance. It's insurance against currency debasement, insurance against banking system failures, insurance against geopolitical chaos. And right now, with everything happening in the global economy, that insurance is more important than it's ever been. The supply and demand fundamentals for silver are particularly compelling. Silver is used in an enormous range of industrial applications. Every solar panel requires silver. Every smartphone, every computer, every electric vehicle, they all contain silver. As the world transitions toward renewable energy and electric transportation, industrial demand for silver is increasing dramatically. But silver mining production has been relatively flat. We're not discovering major new silver deposits. The easy-to-mine silver has already been extracted. What's left is more expensive and more difficult to get out of the ground. At the same time, investment demand for silver is surging. People are waking up to the same realities that central banks figured out years ago. They're looking at inflation, at government debt levels, at the instability in the banking system, and they're deciding they want to own something tangible, something real. And when investment demand and industrial demand are both increasing while supply remains constrained, there's only one direction for prices to go over the long term. The recent crash in silver prices? That was a gift. That was the paper market temporarily overwhelming the physical market, creating a disconnect between price and value. Smart buyers recognized it for what it was and used the opportunity to acquire more physical metal at temporarily suppressed prices. Because here's the thing about these crashes. They don't last. The physical market always reasserts itself eventually. The real question is whether you're positioned to take advantage of these opportunities when they appear, or whether you're sitting on the sidelines watching. Gold's trajectory is even more straightforward. Gold has been rising steadily with occasional pullbacks, but the overall trend is unmistakable. As central banks continue buying, as geopolitical tensions remain elevated, As government debt continues spiraling upward, gold is doing exactly what it's supposed to do. It's preserving wealth, it's acting as a safe haven, and it's rewarding those who had the foresight to own it before the current crisis began. But here's what most people miss. It's not enough to just own gold and silver. You need to own physical metal, not paper gold, not shares in a gold mining company, not a gold ETF. Physical metal that you can hold in your hand or that's stored in a secure vault under your control. Because when the paper market breaks down, when the financial system experiences a real crisis, paper claims on gold are going to be worth exactly what they're printed on: paper. Think about what happened during the 2008 financial crisis. Lehman Brothers collapsed. Bear Stearns collapsed. Major financial institutions that everyone thought were rock solid turned out to be built on sand. People who thought their money was safe discovered it wasn't. The only assets that held their value through that crisis were physical assets, real estate, commodities, and especially precious metals. Gold and silver didn't need a bailout. They didn't need government intervention. They just sat there maintaining their value while paper assets imploded all around them. We're heading into a similar situation now, except this time the stakes are higher. Government debt levels are multiples of what they were in 2008. The Federal Reserve's balance sheet is bloated beyond anything we've seen in history. The banking system is more interconnected and more fragile than ever. And the geopolitical situation is more unstable than it's been in decades. When the next crisis hits, and it will hit, physical metal is going to be one of the few assets that comes through intact. Now, I want to address something important for those of you who have significant retirement savings. If you're sitting on $100,000 or more in retirement accounts, there's a strategy you should know about. Gold IRAs allow you to hold physical gold inside your retirement account without triggering tax penalties. It's a way to get the protection of physical metal while maintaining the tax advantages of your IRA or 401k. I put together a free guide that explains exactly how this works, what the rules are, and how to set it up properly. It's in the description below. If you have substantial retirement savings and you're concerned about protecting them, it's worth checking out. No pressure, no sales pitch, just information that could be relevant to your situation. All right, let's talk about where prices are headed from here. I'm not going to give you specific price targets because nobody knows exactly where gold and silver will be next month or next year. What I can tell you is the direction. The fundamentals all point in one direction: higher. Central bank buying isn't going to stop. Industrial demand for silver isn't going to decrease. Government debt isn't going to magically disappear. The dollar isn't going to suddenly become stronger. All of these factors point toward higher precious metals prices over time. But more importantly, even if prices don't go up, even if gold and silver just maintain their current levels, you're still better off owning physical metal than holding pure dollars. Because the dollar is guaranteed to lose purchasing power. That's not speculation. That's the stated policy of the Federal Reserve. They target 2% inflation, which means they're explicitly trying to make your dollars worth less every single year. 2% might not sound like much, but compound it over a decade and you've lost 20% of your purchasing power. Compound it over a lifetime and your dollars become nearly worthless. Gold and silver don't have that problem. They can't be printed. They can't be created out of thin air. There's a finite amount of gold and silver on Earth, and extracting more of it requires real work, real energy, real resources. That scarcity is what gives these metals their value. That scarcity is what makes them effective stores of wealth across time. Let me give you another historical example that drives this point home. In 1980, gold hit an all-time high of over $800 per ounce. At the time, that seemed insane. People thought gold was in a bubble. They thought it couldn't possibly go higher. And they were right, for a while. Gold crashed and spent the next 20 years in a bear market. But here's the thing. If you bought gold in 1980 at the peak, at $800 per ounce, and you held it until today, you'd still be way ahead. Because gold has risen far beyond that 1980 peak. The people who lost money were the ones who panicked and sold during the bear market. The people who won were the ones who understood that gold's value isn't measured in dollars. It's measured in purchasing power. The same principle applies today. If you buy gold or silver now and prices drop temporarily, that doesn't mean you made a mistake. It means you have an opportunity to buy more at lower prices. Because over the long term, over decades, physical metal preserves wealth in a way that paper currency simply cannot. Now, let's address the elephant in the room. What about the risks? What could go wrong with this thesis? The main risk is that governments could confiscate gold, like the U.S. did in 1933 under Executive Order 6102. Franklin Roosevelt ordered Americans to turn in their gold in exchange for paper dollars. It was legal theft, plain and simple. Could that happen again? Possibly. But there are a few important differences between now and 1933. First, the U.S. was on a gold standard in 1933. The government needed gold to back the currency. Today, the dollar isn't backed by anything, so there's less incentive for confiscation. Second, gold ownership is far more widespread globally now. Confiscation in one country would just drive gold underground or across borders. Third, and most importantly, even if confiscation happened, it would be an admission that gold is valuable. It would validate everything we've been talking about. The government doesn't confiscate worthless assets. Another risk is that technology could somehow replace gold and silver. Maybe some new form of digital currency becomes the global standard, and precious metals become obsolete. But here's the problem with that argument. It's been made for decades, and it hasn't happened. Bitcoin and other cryptocurrencies have been around for over 15 years now, and they haven't replaced gold. They've created a new asset class, sure, but they haven't eliminated the demand for physical metal. If anything, the rise of cryptocurrencies has made people more aware of the problems with fiat currency, which has increased interest in gold and silver. The reality is that gold and silver have survived every technological revolution, every monetary system change, every empire's rise and fall, for thousands of years. They've outlasted countless currencies. They've outlasted countless governments. The idea that they're suddenly going to become irrelevant now is, frankly, absurd. So what should you do with this information? First, educate yourself. Understand the difference between paper gold and physical metal. Understand how the markets work. Understand the risks and the opportunities. Second, if you don't already own physical gold and silver, start acquiring some. You don't need to go all in. You don't need to bet your entire net worth on precious metals. But you should have some exposure. 10% of your portfolio is a reasonable starting point. 20% if you're particularly concerned about the financial system. Third, think long-term. Don't try to time the market. Don't try to buy at the absolute bottom and sell at the absolute top. Just accumulate physical metal consistently over time and hold it. And fourth, store it properly. If you're buying physical metal, you need to think about security. Some people keep it at home in a safe. Others use professional vault storage. There are pros and cons to each approach. Home storage gives you immediate access but comes with security risks. Professional storage is more secure but means you're trusting a third party. Figure out what works for your situation and your risk tolerance. The bottom line is this: we're living through a monetary transition. The dollar-dominated system that's been in place since World War II is breaking down. Central banks know it. Wealthy individuals know it. Institutional investors know it. The only people who don't seem to know it are the general public, and that's because the mainstream financial media isn't telling them. They're too busy talking about stock market fluctuations and interest rate predictions and other short-term noise that doesn't matter in the big picture. What matters is that the purchasing power of fiat currencies is being systematically destroyed. What matters is that physical assets, especially precious metals, are the only reliable way to preserve wealth across this transition. What matters is that the window to position yourself properly is closing. Not because gold and silver are going to become unavailable, but because the price of entry is going to keep rising as more people wake up to what's happening. Every major financial crisis in history has been preceded by the same warning signs we're seeing now: excessive debt, currency debasement, geopolitical instability, banking system fragility. And every time, the people who protected themselves were the ones who owned physical assets. The people who got wiped out were the ones who trusted the system, who believed that paper wealth was real wealth, who thought that governments and central banks would protect them. You have a choice to make. You can continue holding paper assets and hope that the system holds together. Or you can take responsibility for your own financial security and acquire physical metal that will hold its value regardless of what happens to the dollar, the banking system, or the government. It's not a complicated decision. It's not even a particularly difficult decision. It's just a decision that most people won't make because it requires them to think differently than they've been taught to think. The financial establishment wants you to believe that gold and silver are barbarous relics, that they're outdated, that they're for conspiracy theorists and doomsday preppers. They want you to believe this because if everyone started buying physical metal, it would expose the fraud at the heart of the monetary system. It would reveal that the emperor has no clothes. It would force a reckoning that the powers that be desperately want to avoid. But the reckoning is coming anyway. The math doesn't work. The debt can't be repaid. The currency can't maintain its value. The system can't continue as it is. And when it breaks, the only question that will matter is whether you positioned yourself properly beforehand. So here's my challenge to you. Stop making excuses. Stop waiting for the perfect time. Stop thinking that someone else is going to protect your wealth for you. Take action. Buy physical metal. Not tomorrow, not next week. Today. Because every day you wait is another day that your purchasing power is being eroded. Another day that the risks in the financial system are building. Another day that you're exposed to forces completely outside your control. And for those of you who made it this far, who watched this entire video, I want to offer you something special. That free guide I mentioned earlier, the one in the description, if you're an American retiree with at least $100,000 in any retirement account, and you mention that you watched this video all the way through, you'll get access to an exclusive one-on-one educational web conference. No obligation, no sales pressure, just a detailed walkthrough of how to protect your retirement savings using physical precious metals. It's only available to people who meet those criteria and who specifically mention this video. So if that's you, check out the link in the description. The time to act is now. Not because I'm trying to create false urgency, but because the urgency is real. The monetary system is breaking down in real time. Central banks are positioning themselves for what comes next. Wealthy individuals are positioning themselves. Institutional investors are positioning themselves. The only question is whether you're going to position yourself, or whether you're going to be one of the people who looks back in 5 years and says, I saw the warning signs. I knew what was happening. I just didn't act. Don't be that person. Own physical metal. Protect your wealth. Secure your financial future, because nobody else is going to do it for you.